All right, folks, welcome back to another quick video of me just breaking down my process and everything that I'm doing on a day-to-day basis to achieve long-term consistency in the financial markets. So I'm just going to break down today's trading session and the project that I'm working on outside of the live trading hours. So let's get into it. Get myself out of the way here. I'm gonna put myself over here. No, right there. Actually, maybe like right here. All right, that's cool. All right, so let's go ahead and break down my daily price action log, just the things that I keep track of. Number one, I just like to name the day. And the main event for that session, by main event, I mean what was going on in the economic calendar, the date, today's June 3rd, 2025. The profile, these aren't profiles from ICT himself. These are just kind of things that I noticed and that things that I just named. But I know the concept of a market profile did come from him. This is just what I'm looking for. The draw on liquidity, did I get it correct or incorrect, or was I unsure? And then my bias for today. So today was bearish, and the level that I was looking for did deliver, and the price move that I was looking for did deliver, although today was an up-close candle. So I'm sure you know if you're trading the NASDAQ or the S&P 500 or any stock indices. Today's day is Monday, and I like to grade my performance. So I gave myself a B today because the first trade that I took was premature, and I was trading for pattern's sake, really. It wasn't really a why behind the trade, but the second trade, I saw the logic was there, valid, in price, clearly present, so I took it. And then the drivers that we had today, we had a high impact driver at 9:45 and a medium impact driver at 10 o'clock. So starting with today, I just like to work from the weekly all the way down to the daily and just annotate what I'm seeing in price. So weekly, daily, 4 hour, 1 hour, 15, and 1 minute. Everything that I'm looking for, levels of interest, my bias, why is that my bias, everything. And then after the session is over, I like to do a post-market analysis where I'll go back in and I'll annotate basically how price played out and why it played out like that. Just a good, clean hindsight study, explaining to myself in hindsight why price delivered, how it delivered, but at the same time also comparing what I was looking for versus how price delivered, which you can see in my annotations here, what I wanted to happen versus what actually happened. So I was bearish on the day, but today ended up being an up-close candle. That didn't mean that there was no opportunity to sell the market short, because there was, that was valid, where my model was present. And then at the end of the page, I just like to stick my trader view where I just put the screenshots of my recorded trades apart from my trade log. And I take it from my trade log and I put it in the daily price action log. So everything is here clean on one page. So if I need to go back to any specific date and know exactly what I was thinking and what happened when the market closed, I can do that. Everything's nice, clean, and organized. So that being said, let's go ahead and break down today's session. Now, where should I put myself here? Let's go like right there. There we go. Cool. All right, so the daily. On the daily, I was kind of leaning bullish, but on the 4 hour, what I saw on the 4 hour made me lean bearish. But on Friday, we can see that the market opened, it traded down and cleaned these relative equal lows, but it closed. Where did that candle close? Back inside the range. So this tells me that the market's pretty comfortable where it's at. It's not really going to break lower from this consolidation range, and I'm anticipating the market to stay in consolidation and treat it like it's in consolidation until it really shows us that it has left the consolidation. That's kind of something that I literally just learned today. Because before, if the market would be, let's say the market's clearly consolidating, I would expect like this candle to be a trending day and expect the conditions to flip on that day. But I learned, like, why not just trade with those conditions until they change, until they clearly change. So that's kind of how I treated the market today. And it worked for my approach. So on the 4 hour, I liked how this large down candle overlapped this up candle, making that a bearish order block in my eyes. And you can see that the 2 o'clock candle opens, it trades up into the open price of that candle, but it closed below the open price. So that's the signature that I follow. That's basically the foundation for my model that tells me whether I should lean bullish or bearish. It's just looking at where these candles close. So if this candle trades into the up candle that I'm anticipating the market to reject, and it closes below the open price and it leaves this premium wick, at this point, I have one of two options. Number one, the market is going to trade into this premium wick, reject it, and reverse lower. Or number two, there's going to be a drive above this high that fails and then breaks lower. Now, in this case, the market broke above this high and failed within the 10 o'clock 4 hour candle. But this candle offered so much volatility, it ended up closing near its high. But there was opportunity to be a seller within this range targeting this candle's low. Now, since we opened up in the middle consolidation range, you could really frame this both ways, but I was leaning bearish because at the same time, This candle closed below that one, indicating weakness. This candle traded into this gap, the new week opening gap, and closed well above it with this large tail, also indicating strength. So you could have played it both ways. I was leaning bearish. And then on the hourly, inside of that large 4-hour candle, there's a separation between this candle's low and that candle's high. So I'm watching this gap to see if the market wants to reject that. Now I can already see that these 3 candles have rejected the gap, but they all, notice how they did not take the previous candle's high. So these highs are what? They're relatively equal. So when it does this and leaves the gap, and this is a solid up candle laid over this large down candle, not large, but the solid up candle that closed near its high, laid over this down candle. I want to see the market trade into this down candle and then work to these highs where I want to see the market reject that. And that's what I was looking for going into the day. If I go to my recording on the hourly time frame, I said with this solid up candle, I want to see price trade into the down candle, then work for the 3 consecutive highs that did not take the previous and reverse lower. I want to be a seller above that high. So basically going into 9:30, I'd look to see a run above these highs fail for a short. But what I wanted to see happen, which kind of made the bias tricky, is on the 15-minute, I wanted to see it work towards those highs first, leave all this intact, and then work for those lows. But it didn't do that. It dropped lower first. I knew the market wasn't likely to find support within this price leg because there's nothing solid in here. There's no solid discount rays that are just so clear and obvious that the market can drop into and then rally higher. That's why I wasn't looking to be a buyer on a retracement into this price leg and then target the London highs. I wanted to see it trade higher first, clear those London highs, and then reverse, because this is incredibly smooth. And to me, that's what I view as liquidity. And I'm targeting that. I'm using that as a reason for the market to want to go there, because where the market is smooth, that's where the liquidity is going to be, which gives the market a reason to go down there. So I'm pairing the information that I see on the close of higher time frame candles from the 4-hour and the 1-hour, pairing that logic with liquidity. So how the higher time frame candles close tells me the market should move away from that level, but I need a reason for it to move to the other side of the marketplace, which would be this right here, where the market's smooth. And that's basically my trade model, and that's basically how I see the market, and that's the approach that I've kind of been dialing in on. It took me a really, really, really long time to settle in on this, but that's what I look for. You can see initially the market was strong, and that kind of confused me in what I was looking for, because I thought it could potentially just keep continuing higher. And I know that I did not have a read on price, because if I go to my session commentary and I go to 10 o'clock, I ask myself, what am I thinking? Well, I was looking to be a buyer, a continuation play, and a seller, a reversal play at the same time. And from my experience and from what I've noticed, my worst trading days always come when I do not have a good read on the market, when I don't know what the draw on liquidity is. How do I know that I don't have a good read on the market? Because I'm looking to be a buyer and a seller at the same time. That right there tells me that I have no idea what the market's reaching for, and I need to step aside and wait for some more information. Those are the days where I always hurt myself. Today, I was kind of feeling like that. But after 10 o'clock, I got more and more and more information. And eventually, on this candle right here, the reversal is very obvious, very clear and very obvious. Now, what makes the reversal valid for me here? On the winning trade that I took, this candle trades higher, took that candle's high, but closed below it. And it also closed still inside of that 1-hour gap, right? This candle closed near its high. This one opens, takes that candle's high, and immediately fails. But when this candle does this, takes that candle's high and closes lower with this premium wick, that's my first sign of weakness. From then on, I can look for the market to reject this premium wick, or I can look for a rally above that high fail. That's my model. That's my approach. And then with this logic here, I just need to pair that with smooth liquidity on the other side of the marketplace to give it a reason to go there, which in this case, there is a reason to go here, because the drop lower at 9:30 didn't take these lows, so it made them relatively equal. So it's just prime liquidity, just engineered more liquidity down there, and it goes down there, attacks that, and then we see the real move of the day. But I just pair that together. Number one, where the higher time frame candles close, and number two, liquidity on the other side of the marketplace. So if I go in and break down my losing trade, I'll explain why I was a losing trade. Just a small loss, just a hair. It was because as the market's trading higher, here's a couple things that I'm noting as it's trading higher. Number one, we have not seen any kind of run on minor sell side liquidity, like at all. And number two, I really liked how 10 o'clock opened with no wick. Right there, right? There's a 10 o'clock open. Usually when the market opens like this and it has literally no wick on that hourly candle, if we go back up to the hourly, like this is what it looks like on the hourly, right? There's no wick on that candle. Usually the market goes back there. So I like to use that as a draw in itself, which is something that I've discovered that just repeats. So I'm annotating that, extend it out in time, and it does deliver. Market does come back to that open price. There's no low work on that. There's no lower wick on that hourly candle, and usually it doesn't say like that. Usually the market draws back to that. So here, at this point, the market just keeps trading higher. At this point, I'm thinking there's probably not going to be anything for me to do. And at this point, I'm thinking it's just going to keep trading higher and going without me. And the only thing that I can do is look to fade the move. And that's where I start picking up on that and how I was feeling at 10:05. So I like how the 10 o'clock candle is opened with no lower wick, but looking for sells here seems low probability. Then at 10:15, it's at the point where I have no choice but to look to fade it. So I'm looking for every reason to fade it. I've been here many times before, but is there actual reason to fade it, or am I just looking for something to do? Because I'm recognizing the situation. I've been in this situation many times before where the market just keeps going higher, and I really don't have no choice but to look to sell it, right? So I'm not going to buy it way up there. I'm going to look to fade it. But is there actually a reason to fade it, or am I just looking for something to do? Is there actually logic behind why the market should reverse? Or am I just trading for pattern's sake, wanting to put some risk on and just get something on out there and just do something? So I was kind of feeling myself in that situation right here, and that's where I put on this lower probability trade, because at this point, it wasn't really, really, really clear. Like all the steps, not all the boxes were checked for my trade model at this point, up until this point, at 10:28. Now it was really, really clear after the market drove above that high and failed. That's when everything was there. Everything that I needed to see was there, and I was able to just take that gap with no hesitation. At this point, it wasn't, and I was just looking for the first possible inversion fair value gap to sell short on. So I annotated this, and when I drop to the lower time frame, what I need to see to confirm the trade is a large candle come in. This large candle comes in, and that confirms a reversal for me because it closes over this buy side imbalance, sell side inefficiency, closed over that. So I sell short on these up candles here. There's my execution right there. Put a stop loss above that right there. And I'm just looking for a drawback to the 10 o'clock open price, right? The issue with this is it was too early. It's too premature. And the only reason that I took this was because I wanted to do something. So the situation that I recognized I was in, I actually folded and put myself in that low probability situation. Now I took this trade off before it took my original stop loss. I didn't realize the full loss in the position because look what these candles are doing. There's like no body on them. They're extremely wicky, right? They're not full body at all. And this just tells me that the market's refusing to break lower. And we see this consolidation, it stays sideways. This right here tells me that it's not breaking lower, because look what these candles do. See how it makes this large wick, right? This lower wick. At one point that was a bold face down close candle, but it's still closed back inside the inversion fair value gap. This is not how I would want to see it react at all. I have to see it trade up into that and then boom, leave it immediately like that. So when it gives me this information right here and each range just overlaps the previous and it's just consolidation, I know that it's likely to make a higher high, and boom, it does, makes a higher high and fails. That is when I really see large down candles come in with speed, leaves an obvious gap. And at that point, I'm looking at the 5 minute. You can see on the 5 minute. The 5 minute also tells me that the market was not ready to break lower right here, because if I just get rid of this right here, I take the executions off. This candle at one point was a bold face down close candle, right? But how did it close? It still closed inside of this consolidation range. If the market were to reverse here, this candle should have closed near its low like this one. So when I see this candle open, take that high, and boom, overlap the down candle, close near its low, that's it. That's what I'm looking for. So I see that information. I'm looking at the 15 minute. I'm looking how the candles have closed and how they're developing and how they're painting, what time it is. What time do I sell short? 10:50, right at the start of the macro. It's perfect. It's everything that I need to see. I take the obvious gap, and I'm just targeting that low right there. 30 handles, that's all I need. I'm learning. I'm developing. I don't need anything more. I just need consistency. And a lot of times in the past, I would have to fight myself. I would have to deal with greed. You know, why Right now, there's no need for me to prove to myself that I can make like $1,000 a trade on the NASDAQ, 50 handles. I don't need to do that. I just need like consistency, timing the market, and executing my model because I know what it is. I just need to practice executing it. This is a solid little short setup. My stop loss was above the volume imbalance right here, so it actually would have came back and knocked me out had I not taken profit fast right here. But because of the high resistance conditions, the better stop would have been above the order block, which doesn't get tagged. So it does deliver a 10 o'clock low. If you note, another reason for the market to draw lower is what I outlined earlier. How it never took that low right there. Boom, relative equal lows. Not one run of minor sell side liquidity here. And first presentation wasn't really used much at all. Whenever first presentation isn't really used much at all, it kind of comes back to that. That's what I've noticed. And this video is already 15 minutes long and I haven't gotten to anything else. So I'm just going to go ahead and review the lessons that I learned today. What I learned from this, well, I learned what separates a good trade and a bad trade. What makes a bad trade? Bad trades have no why behind it. There is no reason why for the market to trade that other direction. You just want to put something on or you're trading for pattern's sake. In this case, I had no choice but to fade the market. So I'm just looking for the first sign of weakness or just the first thing that I could sell short on. And as soon as that popped up in price, boom, I sold it. There was no why at this point in time. My model wasn't clearly present in price action. From start to finish, all the boxes checked. It wasn't there. I just wanted to do something. I was trading for pattern's sake. The logic isn't actually behind that trade. The difference between this trade, the losing short, and this trade is I'm looking at the market here and I ask myself, why would the market go back up to this high if it's already taken that one and then broke lower with this speed? Why would it go back up there? I asked myself that. Why would it go back up there? It wouldn't. So what's it going to do? It's going to at least take out these lows, and that's all I need. So I'm selling short that, and I'm just aiming for these lows. This trade works because it has the why behind it. Why would the market go back up here? It would not. So what's it going to do? It's going to go for these lows. This trade does not have the why behind it. You can know how it leaves all these smooth highs behind, right? And this is what was really concerning me, how there wasn't a lot of speed. Yeah, we had large down candles coming in, but there wasn't a lot of speed like this. It's like boom, boom. And it leaves that obvious separation right there. And then we actually have a market structure shift here, retracement, and then it rolls over. But there has to be a why behind the trade. You can see even on the 1 minute, the body never leaves that hourly gap. And that's exactly the thing that I follow right there. So what separates a good, solid trade from a bad one is the logic. Why? Why should it do that? If there is no why, it's not a good trade. If there is a why, it's a good trade. And that's what I learned today. Thank you for watching.